So question 2, a woman visits a solicitor. The woman informs the solicitor that she's a director of a company, e.g. the corporation, in which she is also employed. She explains that the corporation is wholly owned by a German company, which is a holding company, that all the other directors of the corporation or executives of the holding company reside in Germany. The woman resides in Wales. The woman explains that the holding company has requested the corporation acquires a particular commercial property in Cardiff, e.g. the premises, from which the corporation would operate to develop its existing business in the UK market. The woman further explains that the board of directors, e.g. board of directors of the corporation, e.g. the board, has conveyed to consider the holding company's proposal and has unanimously resolved to proceed with the acquisition of the premises, as it determined that such purchase would promote the success of the corporation. The solicitor is asked to provide legal advice regarding the acquisition of these premises. So, which of the following statements best explains who is the solicitor's client? A, the holding company, because the corporation is wholly owned by it. B, the woman, because she is the director of the corporation who is a resident in Wales. C, the corporation, because it is the corporation that will be acquiring these premises. D, the holding company, because the holding company requested that the corporation acquire these premises. Or E, the board, as it's unanimously resolved to proceed with the acquisition of the premises. So again, another 2 kind of minutes to go over this and come with some answers. I see we have a few more have joined. Just continuing using the chat throughout, guys, please. Okay, so the answer is in fact C, because the corporation who is kind of acquiring these premises, well, it's the corporation that will be acquiring the premises. So the question kind of examines when the fundamental principle of the client in a corporate transaction. So when a solicitor is instructed to advise on a corporate transaction, the client is typically the company itself and not its individual directors, shareholders, or parent companies. So companies are separate in their own legal entities with their own legal personality, distinct from the kind of directors and shareholders. So an example of this is Salmon v. Salmon & Co. Ltd. 1896. So in this scenario, the corporation is seeking legal advice about acquiring a property, despite the fact that the instruction comes through one director, and despite the corporation being wholly owned by the holding company, the solicitor's professional relationship is established with the corporation itself as a legal entity undertaking this transaction. So we're looking at a question here which is identifying the client in corporate transactions, which is fundamental for any kind of professional practice. So in this scenario, we've got the woman who's the female director approaching the solicitor about a property acquisition, and she works for a UK corporation. However, it's wholly owned by a German holding company. So the board has already approved this purchase, and she's seeking legal advice on the transaction. So the answer is C, as mentioned, because it's the corporation that will be acquiring the premises, and it's not the lady that's acquiring this. So it reflects one of the most fundamental principles in company law and the separate legal personality of a company. So as mentioned, the landmark case is Salmon v. Salmon in 1896. English law has created a company as a distinct legal entity from its shareholders and directors. So A suggests that the holding company is a client because it owns a corporation. This kind of misunderstands the separate legal personality, and the ownership doesn't create a solicitor-client relationship. Option B suggests that the woman director herself is the client, while she's not the person physically meeting with the solicitor. She's an acting agent of the corporation, and it's not in a personal capacity. Option D suggests that the holding company is the client because it requested the purchase, And again, merely suggesting an action doesn't establish a solicitor-client relationship. Option E suggests the board itself is the client, and this is incorrect because the board is not a separate legal entity, and it's simply the collective decision-making body of the corporation. So the question is testing crucial professional conduct principle, and you must correctly identify your client in order to properly discharge your professional obligations of confidentiality, loyalty, and avoiding any conflicts of interest. So for the SQE exam, you need to remember, when advising corporate transactions, your client is typically the company itself. And regardless who gives the instructions or who owns the company, this is significant implications for the legal professional privilege and conflicts of interests and your duty of care. So let's move on to question 3. So a private company, Greenwood's Suppliers Ltd, entered into a contract with another private limited company, Festive Retailers Ltd, for the supply of 5,000 artisanal Christmas decorations at a price of 145,000 British pounds. The contracts explicitly stipulated that interest at 7.5 per annum will be payable on all overdue payments. Greenwood Suppliers Ltd delivered the decorations in full compliance with the contract terms, but Festive Retailers Ltd has failed to remit payment. Greenwood Suppliers Ltd has fulfilled all requisite pre-action protocols and now intends to commence legal proceedings against Festive Retailers Ltd for the outstanding sum and interest thereon. Greenwood Suppliers Ltd solicitor is preparing the claim form. Which claim for interest should be included in the claim form? A. Interest at 8% per annum under Section 35 of the Senior Courts Act 1981 or Section 69 of the County Courts Act 1984. B. Interest at 7.5 per annum under the contract. C. Interest at 8% per annum over the Bank of England base rate under the Late Payment of Commercial Debts Interest Act 1998. Interest at 10% per annum under Section 35A of the Senior Courts Act 1981 or Section 69 of the County Courts Act 1984. E. Interest at 1% per annum over the Bank of England base rate under either Section 35A of the Senior Courts Act 1981 or Section 69 of the County Courts Act 1984. So, just give you a few minutes for that. Okay, let's move on to the answer. So the correct answer is in fact B, interest at 7.5 per annum under the contract. So this question tests understanding the different regimes for claiming interest on commercial debts and the hierarchy between them. So when parties have expressively agreed on the interest rate in the contract, this contractual provision takes precedence over statutory interest regimes, and the principle of freedom of contract allows parties to determine their own terms, including interest rates for late payment. The courts will generally uphold these terms unless they are penal in nature. So in this scenario, since the parties explicitly agreed to interest at 7.5% per annum on overdue payments in the contract, this is a rate that should be claimed, and the contractual rate displaces the various statutory interest regimes that would apply otherwise. So this question is about claiming interest in commercial debt proceedings. So in our scenario, we have Greenwood Suppliers who have delivered the Christmas decorations to Festive Retailers but haven't been paid the £145,000. So this contract includes an interest clause of 7.5% on these late payments. And the question asks what interest claim should be included on the claim form. So the in fact correct answer is B. Interest at 7.5% per annum under the contract. And this illustrates a fundamental principle in commercial litigation. When parties have expressly agreed an interest rate in the contract, this contractual provision takes precedence over all statutory interest regimes. So why the other options are incorrect? A refers to the 8% interest rate under Section 35A of the Senior Courts Act or the Section 69 of the County Courts Act. They only apply when there's no contractual interest rate agreed. Option C refers to Late Payment of Commercial Debts Interest Act 1998, which provides interest for 8% over Bank of England base rate. So this again statutory regime is displaced by express contractual provision. D&E suggests different judicial rates of interest, but neither of them would apply, and there's a valid contractual interest course. So this question tests your understanding with the hierarchy of interest claims in commercial litigation, and the principle is quite straightforward, to be honest. It's freedom of contract allows parties to set their own interest rates, and these agreed terms will be enforced by the court. So in practice, when drafting a claim form for a debt claim, you should always check whether there's contractual interest provisional first. And if there is, that's what you claim, not the statutory interest rates. Only if there's no contractual interest clause would you turn into a statutory regime. So remember this hierarchy for your SQE exam. Contractual interest provisions take precedence over all statutory interest regimes. And this reflects a wider principle that in commercial matters, the courts generally respect the parties' freedom to determine own contract terms. So, question 4. And I see, David, you haven't given about the knowledge point. You know, this is what you're here for, to learn. So any questions, please do ask. A woman holds shares in a small private limited company. The shares are not held within an individual savings account, e.g. an ISA, during the 23-24 tax year. She receives a dividend payment of $6,500. Her only additional income comes from her employment, and a total taxable income, inclusive of dividend, amounts up to $43,500. For the 23-24 tax year, the personal allowance stands at $12,570. The basic tax rate band spans from $12,571 to $50,270, and the dividend allowance is set to £1,000. How much income tax, if any, should the woman pay in the dividend? A, none, because the dividend was paid by a private limited company whose payment of corporation tax on its distributable profit satisfies the woman's liability for income tax. B, none, because the taxable income included in the dividend does not exceed the upper threshold for this basic rate tax. C, she should pay income tax, this income base rate, on the entire dividend because it exceeds her annual dividend allowance. D, she should pay income tax at the appropriate dividend rate and the proportion of the dividend exceeds her annual dividend allowance. Or E, she should pay income tax at the income tax additional rate on the proportion of the dividend that exceeds her annual dividend allowance. So the 2 minutes on that one. So don't worry about missing the time as long as you're here now. So let's move on to the answer. So the answer is in fact D. So she should pay income tax at the appropriate dividend tax rate on the proportion of the dividend that exceeds her annual dividend allowance. So this question tests the understanding of how dividends are taxed within the tax system. Dividends are subject to special tax rates that are distinct from the standard income tax rates applied to employment income. So when an individual receives dividends, they benefit from a dividend allowance, which was £1,000 in the 2023-24 tax year, which means the first £1,000 of the dividend income is tax-free. Any dividends received above this allowance are then taxed at specific dividend tax rates, which vary according to the individual's income tax band. In this scenario, the woman receives a dividend of $6,500 and a total taxable income of $43,000, placed within the basic tax rate, which is $12,571 to $50,270. So therefore, she would not pay income tax on their dividend as follows. So the first £1,000 of a dividend falls in within the allowance and is not taxable, and the remaining $5,500 is taxable at the basic dividend rate, which is for the 23-24 year, 8.75%. So therefore, her liability for the tax on the dividend would be $5,500 times 8.75%, which would come out at $481.25. So on this question, it's about dividend taxation, so it's a very important topic. So we see that the woman is receiving the dividends of $6,500 from this company, and a total taxable income, including these dividends, is placed in the basic rate as mentioned. So the correct answer is D, as she should pay income tax at the appropriate tax rate on the proportion of the dividend that exceeds her annual dividend allowance. So this reflects how taxation works in the UK. So let me kind of talk you through this. So in the first £1,000 of this dividend allowance, she has £1,000 to play with in the dividends. So that means only 5,500 are taxable. Of the dividends are taxable. So secondly, since she's still in that basic rate taxpayer, she gets a basic rate dividend allowance, which is 8.75% on this amount. So she has a tax liability of £481.25. So why are the other options incorrect? Option A reflects a common misconception in corporate tax paid by the company, eliminates the shareholders' tax liability. While this principle aims to avoid double taxation, shareholders still pay income tax on dividends in the UK. Option B is incorrect because being in the basic rate band doesn't mean dividends are tax-free. Option C suggests taxing the entire dividend at the basic rate, ignoring this initial allowance. And option E suggests using the additional rate, but our taxpayer is clearly in the basic rate band. So for the SQE exam, you need to remember that dividends are taxed separately from other income with their own allowance and special rates. So also note that ISAs can provide tax advantages for investments. Had these shares been an ISA, no tax would have been due on the dividends. So this question tests your practical knowledge of tax rules that clients will expect you to understand as a solicitor. So well done to anybody who got that correct. Let's move on to question 5. Sarah Jenkins owned a flower shop called Blooming Lovely, which she ran as a sole trader in Cardiff for 8 years. She decided to sell the flower shop and become a partner in an established landscape gardening business called Green Horizons, which had been operating for over a decade in Bristol. When Sarah joined the partnership, she took a loan of £15,000 at an annual interest rate of 8% to purchase her partnership share. The loan is still outstanding in full. In 23-24 tax year, Sarah's share of partnership profits in Green Horizons was £42,000. It took longer than Sarah anticipated to find a buyer for Blooming Lovely, but she completed the sale on 6th of April 23, making a profit on the sale of £12,000. For the 23-24 tax rate, the following rates apply. Personal allowance of £12,570, basic rate of income tax at 20%, and basic rate tax band is 0 to 37,700. So, which is Sarah's income tax liability for the 23-24 tax year? A, 5,686, B, 5,886, C, 7,886, D, 7,686, or E, 6,086. Okay, we've got some answers, so let's move on to the actual answer. So it's kind of a few kind of steps on the answer. So you need to initially kind of identify Sarah's taxable income, which is the partnership profits. You can see from the Green Horizons there, which is £42,000. She's then got capital gain from selling the shop, which would be a sale of £12,000. This is excluded, subject to CGT, not income tax. You would then deduct the loan interest, which is £15,000 at 8% interest. So the deductible interest would be £1,200. And then you'd adjust the taxable income, which is £42,000, take away £1,200, where you'd be at £40,800. You'd then apply your personal allowance, which would be the £12,500 in step 4 there. And that would leave you with the £28,230. You then calculate income tax at the 20%, which would leave you with £5,646. So we'll go over that again. So the partnership profits, the top from Green Horizons is £42,000. You've then got capital gain from the shop sale, which is actually included, subject to CGT, not the income tax in step 2. So you only see only the £42,000 partnership profit is subject to income tax, We've then got the loan at 15,000, which is 8%. She'd take that away, take you down to 40,800, and then the personal allowance of 12,570 would be deducted, which would leave you with that 28,230. Do that at 20%, you'd leave with 5,646. So well done if you did get that correct. So some key takeaways for the exam would be that you need to differentiate between income and the capital gains tax. In there, you need to apply tax deductions and make sure, such as kind of qualifying loan interest, which we've seen there on the 8%. You need to subtract the personal allowance before any tax calculations, and then use a methodological approach for this kind of thing. So set out, as we have here, in steps on what you're going to do when attacking this. Okay, so let's move on to question 6. So James Taylor does not make any disposals for capital gain tax CGT purposes in the 23-24 tax year. He made 3,500 losses for CGT purposes in 22-23 tax year. Which of the following statements best describes James's CGT position? He can carry forward both his 3,500 losses and his 23-24 annual exemption indefinitely until he has an opportunity to use them. B, he can carry forward his 5,500 losses indefinitely until he has an opportunity to use them, and can carry forward his 23-24 annual exemption to 24-25 only. He can carry forward his 3,500 losses to 24-25 only, and can carry forward his 23-24 annual exemption indefinitely until he has an opportunity to use it. D, he can carry forward his 3,500 losses to a 24-25 tax year only, and cannot carry forward his 23-24 annual exemption at all. And he can carry forward his 3,500 losses indefinitely until he has an opportunity to use them, and cannot carry forward his 23-24 annual exemption at all. So a minute or two for that. Okay, let's move on to the answer. So the answer for this is in fact E. He can carry forward his 3,500 losses indefinitely, but cannot carry forward his 23-24 kind of annual exemption. So key rules in the CGT in England and Wales is that capital losses can be carried forward indefinitely to offset future capital gains, and there's no kind of time limit for this usage. So James's 3,500 loss from 2023 to 2022-23, remains available for these future gains. But annual exemption has a kind of use it or lose it policy. So if no disposal occurs in a tax year, the annual exemption is kind of lost forever. So since James made no kind of disposals in 23-24, he cannot carry forward this. So in this, we're examining the important concepts of in capital gains tax, so the treatment of losses and annual exemptions. So James Taylor's situation here is he made a loss of 3,500 in 22-23, but had no disposals in the 23-24 tax year. So it questions your understanding of two fundamental CGT principles. First, the treatment of capital losses. The key rule here is that capital losses are a valuable tax planning tool, and they don't expire. So making this kind of useful for the offsetting of future gains. So James's 3,000 loss from 22-23 doesn't expire. You can use it whenever to make disposals in the future. And annual exemptions, which is currently 12,300. This is a use it or lose it. They are time sensitive, but you can maximize tax benefits by spreading these disposals across tax years, and you cannot carry it forward. So since James made no disposals in 23-24, his annual exemption is kind of gone for that year. So this explains why option E is correct. James can carry forward his losses indefinitely, but cannot carry forward his unused annual exemption. So distinction is kind of crucial for tax planning advice. So when we're advising clients with potential capital gains, you might suggest spreading disposals across tax years to maximize the use of the annual exemption, while losses can be saved for when they're most beneficial. So remember, HMRC requires capital losses to be formally claimed. So even if no tax is payable, the claim must generally be made within 4 years of the end of the tax year in which the loss arose. So the statutory basis for these rules are in the Taxation of Chargeable Gain Act 1992. So losses are covered in Section 2, while the annual exemptions in Section 3. So the SQE often tests this area because it combines this technical knowledge with practical application. So make sure you understand the different treatment of losses versus exemptions, as it's a common source of confusion for candidates. Question 7. A professional negligence claim against an accountant has been resolved through settlement. The terms stipulate that defendant accountant must pay the claimant £75,000 damages plus the claimant's legal costs, which is to be assessed on the standard basis. 18 months prior, the claimant had executed a written conditional fee agreement with her solicitor that included a success fee of 90%. The solicitors calculated the base professional charges at 20% before the addition of the success fee and VAT. What sum must the solicitors charge a client for professional fees excluding VAT? A, 15,000, B, 18,000, C, 30,000, D, 35,000, or E, 38,000. Sorry, yeah. So, in fact, the correct answer on this is E, 38,000. So in this scenario, we would have the base professional fee at £20,000, the success of the fee of the base fee, which is 90% of that base fee, which would be £18,000. Total fees then would be the base fee plus the success fee, which would take us up to £38,000. So the key principle for this is who would pay what. So the defendant must cover the claimant's legal cost, but only the base cost, subject to standard basis assessment. So the success fee of £18,000 is not recoverable from the defendant, and the client is personally responsible for paying this amount. So the rule stems from Legal Aid, Sentencing and Punishment of Offenders Act 2012, so LASPO 2012, which removed the recoverability of success fees from the losing party. So some key exam takeaways for this would be that success fees are no longer recoverable from the opposing party in litigation. Clients must pay their own success fees, even if they do end up winning, and standard basis assessment applies only to base costs, not the success fee. So the formula for the total fee to the clients would be base fee plus success fee equals total chargeable fee. So this reform significantly affects litigation funding, as clients must factor in this potential success fee liabilities when pursuing cases. So this represents an important shift in cost recovery that has implications for both solicitors and clients in litigation. So let's move on to question 8. A newly established architecture practice in Leeds is voluntarily registered for value-added tax, e.g. VAT, and provides only standard rate supplies. During the relevant VAT quarter, the practice charges output tax of £12,500 on its professional services and pays input tax of £22,500 on office equipment, design software, and utility expenses incurred for tax business purposes. Which the following statement best describes the practice's VAT position at the end of the relevant quarter? A, the practice does not pay any VAT and cannot reclaim any VAT. B, the practice can reclaim £10,000 VAT. The practice can reclaim £22,500 VAT. The practice must pay £12,500 VAT, and the practice must pay £22,500 VAT. So just on that one. Yeah, so on the question 7, Sarah, it does fall within the scope of the business law and practice, but it's more kind of closely related to professional conduct for solicitors and and has connections to VAT. So we're just introducing the topic here for kind of preliminary discussion going forward. It's not exactly, it's more closely related to the professional conduct for solicitors. Okay, let's move on to the answer. So the correct answer for this is B. So the practice can reclaim £10,000 tax. So in this scenario, we need to understand VAT reclaims. So VAT registered businesses act as tax collectors for HMRC. So charging VAT on their sales, which is output tax, and paying taxes on the purchases, which is input tax. It's the difference between these determines whether the business must pay tax VAT to HMRC or reclaim VAT from HMRC. So the VAT calculation in this case would be the output tax VAT collected from clients is £12,500. The input tax is a VAT paid on business expenses is £22,500. So the net VAT position would be input tax is £22,500 exceeds output tax £12,500 by £10,000. So since input tax is bigger than output tax, the business can reclaim the difference from HMRC. So the VAT reclaim in this would then be £10,000. So why does this happen? The key VAT principles in this would be when input tax exceeds output tax, the business is in a refund position. So it can reclaim the tax difference from HMRC. When output tax exceeds input tax, the business must pay the difference to HMRC. So the situation is common for new businesses with high initial expenses, so your kind of office setups and equipment purchases. So for your SQE exam, you need to take away that VAT registered businesses must calculate VAT each quarter to determine whether they owe VAT or are due a refund. If input tax is larger than output tax, the business can claim a refund. And if output tax is larger than input tax, the business owes VAT. So new businesses often reclaim VAT in the early stages due to high startup costs. So voluntary VAT registration has its pros, which allows VAT reclaims, but also its cons, so its administrative burden. So it tests your understanding of VAT mechanics and the business cash flow implications, which is a crucial topic for the SQE.